Billionaire investor Howard Marks, co-founder of $139.6 billion United States dollars asset management firm Oaktree Capital Group, wrote an investor memo, shortly discussing Bitcoin BTC, but also delving into holding shares, providing points that could arguably be applied to hodling world's #1 crypto. In his recent memo, Marks discussed conversations and conclusions made with his son Andrew, whom Marks describes as a successful, professional investor who focuses on making long-term investments in what the world calls growth companies, and especially technology companies. Finding that value is where you find it, Marks said that he wants to learn more about cryptocurrencies, as he's not yet informed enough to form an opinion on them. He, however, added that Andrew, who is quite positive on Bitcoin and several others, thankfully owns a meaningful amount for our family. Now, keeping this in mind, the section titled Appendix, Dealing with Winners in Practice, becomes a particularly interesting read. In it, Marks presents a version of a common, oft-had dialogue between his son and himself focused on investing, holding, and selling, and though this particular conversation is about shares, given Andrew's appreciation for BTC, it's interesting to observe how the word shares could be easily changed for Bitcoin. Suddenly, we get arguments very reminiscent of those that one can hear from Bitcoin supporters. Marks would ask his son if he's tempted to make some profits when X is up Y% selling at a certain price to earnings PE ratio. This would mean that Andrew is up by a specific amount. Some of the gain should be put in the books to make sure not all is given back. Valuation might be overvalued and precarious, and no one ever went broke taking a profit. Andrew, however, would refuse to sell, stating he's a long-term investor who thinks of his investment as being a part of a business and who can handle a short-term downward fluctuation. Furthermore, that specific company still has potential, he'd say, adding, and now, it's a good time to look at the BTC chart. How about taking some profit if that company project is overvalued in short term? You can then buy lower if it goes down, and there'd be less regret. Andrew argues that selling a part of a something that has enormous potential, strong momentum and great management, is not an option, as great compounders are extremely hard to find, while it's much more straightforward to predict a long-term outcome than short-term price movement. Let's take the mentioned PE ratio as an example. What if it's awfully high? Marks would ask his son. The latter would reply that this ratio is just a very quick heuristic that doesn't necessarily tell you much about the company, it doesn't necessarily mean something is overvalued, and it shouldn't scare one off.